Since our last update, markets have made little progress and remain turbulent. Bond yields have been static and currency and commodity markets remain very volatile. I'm here at Columbia Threadneedle Investments to discuss recent developments with CIO Mark Burgess. Hi Mark.
Afternoon, Deborah.
Can you explain what's happening with volatility in markets?
Sure. As you say, volatility in markets has picked up quite a lot over the last couple of months as investors have become more concerned about the outlook for Chinese growth, what that means for global growth more broadly, what it means for interest rates, what it means for commodity prices, and what it means for corporate profits.
Would you say that some volatility is good?
Some volatility is good as it presents investors with an opportunity to buy things that they might otherwise have bought at lower prices. But the level of volatility we saw in August in particular was very unsettling both for investors and end customers.
Now, China continues to deteriorate. What effect is this having on the rest of the world's growth prospects?
China's pretty important. It's the world's second largest economy. It contains 20% of the world's population, and its growth rate really does matter to the rest of the world. With developed market growth running at relatively moderate levels, a significant slowdown in China would have a big impact on global growth, corporate profits, and the outlook for the world more generally.
Now, you just talked about China being one of the major economies. The US is another one. They decided not to raise their interest rates. What are the repercussions?
The US has been looking to raise its interest rates for a while and more normalised monetary policy. The problem is what's going on in China is very deflationary. The fall in the renminbi is very deflationary. The fall in the emerging market currencies more broadly is very deflationary. And the fall in commodity prices is very deflationary. So despite the fact US growth is running on track, despite the fact that US unemployment is now quite low, there are no inflationary pressures in the US system, and that has taken the wind out of the sails of the authorities in the States, and that's why they didn't raise interest rates, and that's why they might not raise interest rates at all this year, and they may not raise them by very much next year. Deflation's a big feature.
Yeah. So indeed, like you said, we have deflation. Is this temporary, or do you think that this is a permanent situation?
I think it's here to stay.
Yeah.
We remain relatively indebted globally, which in itself is very deflationary. As I said, there are lots of deflationary forces around the world, particularly commodity prices. Labour supply is abundant. I think we are in a low inflation world and a low interest rate world for some time.
Now, Mark, given the falls we've seen this year, are you becoming more positive about the outlook for stock markets?
Certainly share prices have come back quite some way, albeit from mostly all-time highs, and stock markets are down 10, 15, 20%. By definition, valuations are more attractive, and that would ordinarily make us become more positive about investing in shares and thinking about positive returns for next year. I guess the caveat would be that we've got quite a lot of profit downgrades to come, we think. So certainly for companies that are involved in energy, mining, the resource sector, despite the falls we've seen, we think we've got more profit warnings to come there. Companies exposed to the Chinese consumer have started to tell us that growth is slowing down, and companies that are exposed to the emerging markets more broadly, I think, are having a more challenging time. So despite the fall, we think there are profit forecast downgrades to come through, which takes valuations to not so attractive levels as you might think.
Mark, thank you very much for your time, and thank you for watching. We'll be back again next month.